Welcome, welcome. We do put it right up top, the investment world's view on SPACs. Let me go to Yieldstreet. Massimo, what is the view of SPACs?
Well, I think generally speaking, there's been so much talk about SPACs these days that, obviously you got to look at it as a very, very useful tool to achieve liquidity. And therefore, obviously has to be positive. I mean, obviously, generally in the past, SPACs have come with a little bit of a negative connotation. And I think I saw some headlines on this from the FT very recently, with the SPACs being able to, get rid of some of their issues, or are they been, qualified in the past. But frankly, it feels to me that anything that allows people to get liquidity and exposure to different exciting companies should be most welcome from the investment world.
Michael, let me ask you this. There's certainly a great amount of enthusiasm for SPACs. We can feel that. Is the understanding there, or does it match the enthusiasm? Do people understand the vehicle, or is there a really steep learning curve on the fly?
I think that's a great question. There's two sides to that question, right? There's the consumer side, the retail investor side, and then there is the company and the sponsor side. On the consumer side, I actually feel there's a lot of education that would be helpful and beneficial to the retail bid in the SPAC. And what do I mean by that? If you understand SPACs, there's the money in the trust, and there's a very small percentage of that money, sub 5%, that's really at-risk capital. And so in an environment where yields are pretty much zero, or very close to it, and thinking about, hey, where should I put my cash as a retail investor with a little bit of upside potential that has probably more recently become very attractive upside potential with very good downside protection. I think SPACs is a place that more retail, more investors really need to be thinking about as a cash alternative, and how to position themselves to have exposure to trusts where most of the money, upwards of 95, 96% of that money is going to be sitting in trust and protected.
Well, Michael, does it worry you though, as from an investment standpoint, when you hear about strategies that people have developed, like, well, buy the SPAC until it announces a deal, then sell on the spike when it announces the deal and get out? Is there some concern that people are buying into SPACs and aren't going to follow through and support the business, once the merger is done?
I think we're seeing a trend in SPACs where people trust SPACs much more and the products they bring to market, right? And so there's been a development over the last decade in how SPACs are viewed as sort of a vehicle to take a company public. I remember, 5 to 10 years ago, SPAC was a pretty bad word. It was a 4-letter word. Today, it's really not at all. And there's going to be different reasons for that. Regulation has really increased and has sort of created an environment where people feel more comfortable. You have better sponsors. You have efficiencies in the pipe vehicles. So I'll put the question back to you. If you're a retail investor who invested in the SPAC at issuance or close to issuance, a deal gets announced and is trading at $12, $13. Are you selling? There's no point in selling, because you're leaving 20% on the table if you would convert. I think there's a much bigger story, right? Which is why we have to educate consumers on why it's worthwhile to stay in if the right deals are getting done. Look at the last 10, 15 years. What are we down 20, 30, 40% of the number of good public companies? When my parents were investing in the market, they got to invest in IBM. They got to invest in some of the most amazing businesses that America had seen grow over the last 40, 50 years. My generation doesn't get that. So what the SPACs are doing is bringing businesses where people could really get exposure. The 60-40 model has been broken, in largely due because we can't find the right growth in the public markets. SPACs are bringing that, right? They're taking some of these companies that would otherwise stay private for longer inside private equity and letting the consumer, letting the smaller investor have a chance at being part of that convexity. And so if good deals get done, I think retail is going to stay in the bid. If people feel that the bad deals aren't getting done, then they're going to run.
I mean, if you look at the SPACs that where after the merger's closed that have gone bad, and I won't name names, but it's often the SPAC bought a company completely different from what its initial target was. What sort of responsibility do you think, Massimo or Michael, do you think SPAC sponsors and the SPACs themselves have to both the companies they're buying and investors beyond just selling a story, a growth story?
Look, I'm happy to take this. I mean, I would say generally, obviously SPACs are still invested by institutional investors. The investors can, of course, always decide. That's the beauty of the SPAC process. That's why I think, so many companies these days are going through the SPAC process, particularly when you look at stories that may not be easy to explain, that maybe don't have as clear comparable in the public markets. You should probably use this as a way to say, hey, this is how I can potentially, explain to real investors that have got, real experience how to value this type of companies. So, frankly speaking, I wouldn't say that necessarily that's the responsibility of the sponsors only. I mean, ultimately, you got public investors that do this day in, day out, and if they don't like the story, they should just, let it go and pass it along. So, obviously, you're right that there is certainly the sponsors would definitely have they would definitely need to find they definitely want to find a target, right? Because ultimately that's how they get their compensation. That's how they get the sponsor promote. But on the other hand, if the deal is not good enough, it should be down to the actual investors to not to stay, not to let the deal go through.
Corey, you want to jump in?
Sorry, I had a slight technical difficulty there, so I didn't want to jump in the middle. Go ahead and finish your thought, Massimo.
No, that's fine, Corey.
I can add a couple comments. Go ahead, Corey.
No, go ahead.
I was going to say that, listen, I think like all things, not all SPACs or SPAC sponsors are equal, nor should they be deemed to be equal, right? You're going to have different people with different levels of experience, different sponsor groups. I think that a couple of things are happening. Number one, there's obviously been a tremendous amount of capital raised in the SPAC market. That's created a lot of competition for sponsors to identify the right companies within the right sectors that they want to see. And so where it's getting a little tricky, Scott, is people are broadening their mandate, right? And so, Brendan, your question about like, hey, how close to your mandate should you stick? The mandate's just gotten a lot wider for a lot of sponsors. On the other hand, I think what people are really understanding is there are different thematic elements that both the institutional bid and the retail bid want to see today in the public markets. I think focusing on what is a good story for a retail bid is really important also, because you're mentioning, SPACs that are getting done were obviously interesting enough to the institutional bid in many cases. They got their pipes done, et cetera, but the retail bid ran away. And so I think there's a little bit more complexity in the market to understanding what type of growth stories investors want to stand behind and want to see grow. And I do think that people should try and stick as close to their mandate as they can, just like you would say about any other investment strategy that someone pitched to you. And in some cases, they'll pay the price if they don't, as you highlighted in those examples without naming them.
Are they narrow enough, Michael? Are those mandates narrow enough? I mean, we're reading, Brendan and I are reading these filings, and we hear sports adjacent, anything involved in tech, fitness, data. I mean, it's not exactly a narrow focus for what we're seeing.
It depends on what your objective is. If I'm a retail investor or even an institutional investor or a family office, and I'm looking for a place to put some cash in a zero yield environment, you could take the position of, hey, I want a team that's going to be really specific and leverage their expertise to go out and find the right merger and help grow that business, and we can keep going. Or you can say, listen, I'm getting a free option with 2-3% risk and a good amount of upside, and if I don't like the deal, I'm going to walk away. And I think the problem is if the sponsors take too much liberty, then you're going to have a decent amount of redemptions. And if you bring a good story and you can show where the sponsorship is complementary to the story, then you're going to get more people to stay in. And so I don't view it necessarily as a bad thing. I just think it's less clarity out the gate, and we'll figure it out when you bring me the story.
Go ahead, Corey.
Yeah, no, Michael, you when we were talking, you had said that a SPAC IPO is the best place for an investor to move cash. And aside from it being low risk and high reward, was wondering what other market dynamics are in place that are making SPACs attractive to investors.
Yeah, in a public forum, I probably shouldn't say anything is the best. So I'll retract that. But again, the reason I think it's really attractive is we're in a zero yield environment, and we mentioned this, Corey, a couple minutes ago. And so any decent story, and I'll sort of highlight where the risk comes in a minute. Any decent story that's priced right seems to be performing fairly well, Okay, and that's like the overwhelming majority. There are going to be situations where they don't. And so if you're in a zero yield environment and you're keeping your cash in the bank, and not to take this conversation 100 other directions, but there's discussion around inflation and how much money we're printing and all this other stuff. How do you think about being, in cash in a bank in a zero yield environment versus having real optionality inside SPACs? I think where that conversation falls by the wayside is understanding that there's also liquidity challenges to being invested in the trust in a SPAC. And so you can't just put money in a SPAC. You need to do your diligence. You need to understand your sponsor group, and you need to realize that there's going to come a point in time where if a deal isn't announced, you may not be able to sell until you wait until the trust is refunding. And so there are some dynamics here that don't make it super simple, but makes it interesting enough, in my view, that it should be a part of your portfolio and you should get educated on it.
Hey, Massimo, I wanted to ask you about all of these athlete-led SPACs that are out there. We saw another one, the Shane Battier SPAC began trading earlier today. Do you see having former athletes or current athletes as an asset or a non-factor when you're evaluating opportunities for portfolio companies?
Well, look, I mean, to be fair, obviously, this is a little bit, akin to what Michael was talking about before, right? Somebody should always do their due diligence on the sponsor group and get comfortable with what sort of capabilities they bring to the table. Obviously, if you ask me, even when I look at what Aser does, I think it's very important to consider, we look at ourselves as somebody that is differentiated because it brings that sort of operational expertise, and that operational expertise can generate different synergies with the sort of companies that you can work with, whether it's in a SPAC environment or whatever other type of investment trajectory you choose to pursue. And so from that perspective, I would say the same is true for athletes. I mean, ultimately, athletes have lots of learnings that they receive from their past career experience that can be very relevant to successful execution. Successful athletes have to really maintain an awful lot of stamina, control themselves, schedule their day, learn how to operate in a team. Those are all relevant skills. And obviously, it's important that people recognize that there is more than just the athletic career to the skills that people can get. So from my perspective, obviously there is the buzz factor. I think Charles was talking about it in the first panel. There is the buzz factor that can be associated with it when you're looking at companies that are more B2C in scope. But more than that, I would say, there is definitely the capabilities that the athletes can have. And frankly, so far, probably not been properly exploited in a lot of cases.
Michael, there's been a lot of talk in some of the previous panels about, whether or not sports teams, publicly traded sports teams, but Yieldstreet is a fintech that's kind of primed for a SPAC. You guys have talked about working with teams to create an investment opportunity with fans or for fans. So I guess the question I have for you is, what has changed in your opinion?
So listen, I think that from my perspective, it's a little bit of a different story going on as it relates to Yieldstreet, and it converges a little bit with this type of SPAC discussion. One of the elements that I think are very attractive as it relates to SPACs and being invested in SPACs is that investors now have the opportunity to participate in the equity convexity and the growth that in many cases otherwise would be locked into private equity or growth equity. And that's a really interesting and compelling story. I think there's a much bigger backdrop going on in society now where the retail investors are saying, hey, let us in. The elitists, the wealthy, the institutions are getting access to investment opportunities that we don't get a chance to see. And that's across every asset class and spectrum. And there's good truth to it. And if the 60-40 model is broken and you're in a zero yield environment, where do you invest to create, a portfolio of passive income and growth and build, a path toward financial independence? And that's what we do, right? And so we focus on bringing institutional quality investments to our platform, where we have a community of 300,000 and growing who've invested over $2 billion already. The part that's interesting to me about investing in sports is a couple of things. Number one, it fits very well, right? Sports is an asset class or an industry, so to speak, that is hyper limited. The rules that the leagues set up across them, whether it's the NBA, the NFL, the MLB, and internationally maybe a little bit differently, make it such that it's really difficult to participate in a fan or as a fan in a brand, in a team that you like, with the exception of a couple solutions. And so can we bring this investment opportunity, which has been reserved for the elitist and for the wealthiest, to retail? I think people would really want to be a part of that. Number two, in an environment like today, where we're only starting to hopefully get back to in-person games, etc., how do we engage with our fans? How do we make our fans feel like they want more out of their team? And I think that being invested in that team, even if it was a smaller amount, is something that's going to add to a person's interest in being connected to their league and connected to their teams. And so I think when you look at it from our perspective, it's yet another opportunity across the risk-reward spectrum that we want to help the average investor be a part of.
And Michael, we know the retail investor would like to get in because of the emotional tie, the fan affinity. Yes. What about the other way around? Do the leagues, in essence, want the disclosure that comes with the public? We heard Colin talk about it. Do they want that scrutiny, or is it a measure of last resort?
Listen, some people aren't going to like my answer, but it's the truth. It's nonsense. It's an institutional excuse, right? So what? It's more disclosure. This is what I deal with every day, right? What's wrong with disclosure? And then institutions want to say, well, people don't realize how risky it is. Sure they do. They just invested in GME and all these other crazy things. What they're asking for is opportunity. What we, the Wall Street institutional world, often like to say is like, yeah, you're not ready for it. No kid likes it when daddy says, I'm not ready to cross the street, or I'm not ready to do something. Or when your kid goes off to college and you tell him, hey, you got to be home at 11 o'clock. He's like, yeah, Dad, I'll see you. The same thing is happening here. I mean, we have this arbitrary view that accreditation means you're more capable of making an investment. So I make 300,000, you make 279, you can't invest. Like, those things are changing, and regulations changing and adapting and understanding that we have to bring more opportunity to people. The reality is that there's a lot of people out there that have a lot of different ideas on how to give charity and do amazing things, and we can't discount that. The easiest way to narrow the inequality, whether it comes to an income inequality or an opportunity inequality, is by giving people a chance to participate in what we invest in. And so I think we should. I think it's a small price to pay. I think that if you explain it properly, which is very simple, I don't have a guarantee of how much we'll make or lose. I can't tell you if we're ever going to be able to give dividends, because that's not how teams work. There are capital calls in place that hopefully you can make, and if you can't, you get diluted. Do you want a chance to be part of what I'm building here? And I think most people are going to say, yeah, there's some portion of my portfolio that I want that opportunity.
All right, let's move on before somebody says the word GameStop and we go all tangential and then we never get it back on the rails here. Michael, Massimo, thank you so much. Corey, thanks for joining us.